following is a presentation of TFNN. The Global Market Pulse. With your host, John Logan. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, John Logan.
Hi, guys. Welcome back to the show, January 13th. And we've got to take a look at a couple of bellwethers here, the S&Ps. We're going to take a look at the weekly here first. And this thing's rattling around pretty hard. The volatility's high. There's no new changes here on the weekly, still in the middle of a fair auction, and the breadth is still positive on the weekly, still hanging in there. This 2028 or 2027 area has been a little, disturbing to me, nerve-wracking to me. It's been, breaking out. We had the other day, breadth turned positive on that note, and we've come back and tried to retest with breadth positive to move higher. Daily breadth is about unchanged right now. Weekly breadth is still positive. So we've, it's been a little bit of a stop out action for me on the north side and the south side of this 2027 area. And that's the way trading goes. Sometimes we've gotten software features disabled. Getting a note here from the den. Okay, I don't know if that's directed to me, but 2027 area has been kind of a stop out area for me. I've gotten stopped out about 2 or 3 times here, and now we're back above 2027. And when the market opens, in my opinion, the breadth on the daily will probably turn positive again. So we've been talking about, the breadth staying positive on the very long term and trying to hang in there on the long term trend being up. But again, 2027 has been a little bit of a disturbing area here for trying to get everybody to stop chatting me here on the couple of mechanisms I got here. Sorry about that, guys, this morning. But we're going to take a look at this still from the long-term stance being long. And I'm still going to orient stops around that 2027 area, because remember, the theme of this always is lose a little, lose a little, lose a little, make a lot. And, again, we're going to just kind of play the odds and play the back testing from time gone past, and stick with that. Large percentage of the market is still on the imbalanced area towards the north side, and we're going to hang on to that concept. Okay. Stops are going to be still below, to sum that up, below 2027 on the long side. Let's take a look at gold really quick, because we've had some movement there, and we talked yesterday about trying to, this is the same thing as the S&Ps. We try to hang in there with a certain concept, and we talked about this around the 1200 area for a long time being back into November. As soon as we broke out above, in the middle of November, above this inflection point here at around 1181, we talked about using that as the launching pad to move higher, get above 1200, hopefully close above 1200. Again, that's what stops are for, and then we've kind of played that game a couple of times here when we played it again recently above 1200, and now we got 40 points in this trade. All right, so the S&P's similar situation. I'm going to go back to it and just do the analogy here, because we've got that extra leverage from the breadth here, and we've talked about buying the dips on this product at times and breakouts, namely recently. Back in mid-October on the breakout on the north side above that 1900 area on this March contract, and then recently breakouts above 2027, and actually some reversal action down here around 1968. So we caught the bid on the weekly around that 1968 breadth area still being positive, no closes below weekly profiles, no technical damage there. And recently we're going to continue to play that game with breadth being positive, breaking out above this 2027 area. Got a lot of earnings out. That's going to maybe affect the market a little bit. You got to pay attention to oil. But again, looking at it from a 30,000 foot view, we still got to pay attention and play the game the same way and take those, relatively tight stops if you're doing intermediate trades. But looking at the long-term view again, this thing has been very, very good to us looking at it over time, and we're not going to change our tune yet and start switching gears to shorting this thing all the time yet. So looking at gold, keeping that same concept in place, that 1200 area has kind of been the pogo stick launching pad for this, and now the dollar giving this thing absolutely zero help is climbing again. And new profile here for the dollar. We talked about this yesterday. Targets above now and resistance area is 92.76, but that resistance area, in my opinion, is not to be sold. You got a dig in buy point down here around 91.17. You got to pay attention to that on the intermediate basis. On the long-term view, guys, again, clear sailing, blue skies ahead, nothing to really get rattled about. And on the 240s, yesterday we found support again, and that was after our show. We talked about letting the 240s regulate this thing up and only taking longs. It's okay to be long, not okay to be short. And look at what happened here around 92.06. We found that bid, and we reached a low of 92.02. So giving yourself a little room. Now you got a 50 cents trade on board here with the dollar, and looking at targets a little bit higher, 92.76 on that particular product. All right, a couple of things we talked about yesterday. Just want to cover them really, really quick. Talked about kind of a excuse me. Wait, let me get away from bonds here. Notes. Talked a little bit about a kind of a lottery ticket play on soybeans. And again, the technical power was towards the north side on the weekly. This is the weekly and the daily. But now you've got, we talked about buying some puts down here well below, and for the report. I normally don't do that, but we've got 1032 sitting here now, unfair highs on the March contract. So that would be more than likely a selling opportunity now, with some technical damage starting to happen on beans. We got 1023 sitting here right now, so maybe another 9 cents retracement. You got a little bit of a selling opportunity, and we're hoping this thing can drip back down to $10, being that we may explore that entire fair auction. And that 90.97 does not coincide with that 90.82 down here, but that's where we're looking for beans to kind of drift south just a little bit here. And it's kind of a waiting game now. There's no leverage is what I'm saying. You've got leverage around 1032 on that March contract. Actually, it was an interesting little report. Wasn't extremely bearish the way I looked at it, but I think it was enough misconception in that report to cause the thing to sell off, obviously. All right, we're going to take a look at silver, because silver is actually making some moves now, without question. We talked about this a lot. We talked about at least getting back above 16.87. We're trading about $17 right now, but the powerful inflection point here again, 1703. I'm still a big fan of kind of staying away from silver and focusing on gold, because kind of look at what's happened recently with silver. It's kind of just getting back into recent highs, and if you look at gold, gold is kind of eclipsing these recent highs a little bit. So this is kind of holding true for the relative strength trade of gold versus silver. And I think gold's possibly a much better long than silver. But if you guys are trading silver, you're reaching a major situation here at the bottom of the box at 1703 on the weekly, and you got 1735 to clear, actually, to get out of the daily technical pattern from okay to be short, not okay to be long, if you can see that. I mean, we kind of got our neck above before around this 1675 area that was really important. To cause technical damage on the downturn on silver, you've really got to get back above 1735, even on the intermediate basis. On the long-term basis, if we get above 1735, we're more than likely going to drift up into 1830. But again, we're at a major kind of intersection here around the 17 area on silver. And as we've seen lower lows on silver, we haven't seen any divergences. And this doesn't doesn't look really turnaroundish to me. But again, if we're going to play things from the long side, I'd rather look at gold. Okay, got to take a look at crude oil because this thing is just. We talked. I even did the free video yesterday on the XLE relative to crude oil, and I'd like to go through that just a little bit here. But crude oil, we talked yesterday. It's kind of okay to be short, not okay to be long. After we crossed the borders of 47.72, had a long talk with my partner in Spain about crude trading yesterday, and it's you got to be willing to, if you're going to try to pick a bottom on crude oil, you've got to be willing to stop yourself out because, as in 2008, if you guys were trading then, I personally was messing around with crude oil in the 40s and it hit the low 30s. So, I mean, this thing, crude oil went to sub $10. I remember back in, at one point I was trading in my lifetime. I'm not saying that's going to happen, but anything can happen when you're trading commodities. These moves can get over exaggerated. And this is a situation where $44 could become $34 really quick. So, and it may not ever come back. I mean, there's a lot of talk on some of the things I'm reading now, which is kind of bullish actually, because everybody's getting on the same bandwagon that, crude oil's going to head lower, blah, 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 blah. But this thing may rest, it may pop up a little bit. It doesn't ever have to go back to the 60s and 70s. So dollar cost averaging this in, and I hate that word, may not be the way to play crude oil. You just got to take your medicine and kind of regroup if you're trying to pick a bottom. But right now, again, it's okay to be short, not okay to be long. And we looked at the XLE. There's a long term on crude oil. Whew. We looked at the XLE. And we looked at this from a kind of hanging in there standpoint. We're trading 73.71 right now, hanging in there standpoint relative to crude oil. Here is that 74.18 area. We closed 74.16, so we're kind of still rattling around here. We're not eclipsing recent lows on XLE as crude oil is just continuing to dive lower. So this is, again, kind of Custer's last stance down here around 74. Talked about putting stops in below 74 with a couple of institutional guys yesterday. We're getting, especially pre-market here, 73.71. So we're getting into the situation. If you're giving yourself a buck to be wrong here, you're getting close to that. Got about 70 cents left on that. And some of the bellwethers that are comprising the XLE, ExxonMobil, we talked about that, bouncing off that 89.49 combined with the daily numbers. And we're going to talk about this a little bit further, some of the internals of the XLE when we come back, just to recap what we spoke about yesterday a little bit.
How would you feel if you had a powerful decision-making tool that has the ability to find high-probability trading opportunities across multiple time frames in equities, currencies, and futures? Search no more. Take advantage of the best trade with the TAS Profile Scanner. Trade with confidence and clarity while using the software that thousands of institutional traders rely on to help them make the best and most accurate decisions. Scan over 1,000 equities, currencies, and futures instruments for high-probability trading setups utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time, for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. Subscribers will also gain access to the December 9th workshop with John Logan. There's no obligation to pay anything. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com. Check out the new look of Tiger TV. Now you can see all hosts, charts, and computer screens live in high definition. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Thinkorswim, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV. Now, crystal clear in high definition, 24 hours a day, 7 days a week. If you haven't seen the new look of Tiger TV, then visit TFNN.com. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. John takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, guys. Welcome back to the show. I heard we have a caller. Eddie?
Good morning, John. Good morning.
Hey.
Good morning,
Hey.
John. Good morning, everybody.
How are you? How are you today?
Like every day, John. Looking forward.
You got it tough
This is
over there in southern Spain. I know it's the weather's usually relatively good there.
Yeah, I heard. We kind of talking to you and others in Chicago, and you that what kind of weather you have, especially not only this year but in the last 2 years. It's a major change, right, John?
It's unbelievable. And on that note, like how in the world does crude oil and natural gas continue to make new lows when the weather's, I mean, from a fundamental standpoint, it's quite amazing, especially on the natural gas scene,
Speaking about this subject about oil, I was going long yesterday and a day ago when a new profile appeared with the profile lows or supply, or demand area 148.70. It was 148.40, 148.70, and I tell you, good thing to have that profile distribution areas. I got my buttocks, handed up to me, and scrambled real quick out, but still occurred little losses, and not reverse position to the shorts. Kind of been, But well, that level 148.40, it was a support area, and now where the market is, it's just very good to have those distribution areas of the supply and demand.
Awesome. Yeah. I mean, we were talking about that, and you actually did a little bit of a play the other day when we had that new profile start to, attempt to appear. And that 47.72 is something we talked about yesterday that, we're going to have to give it a little bit of noise below there, but thank God that, we use stops. I mean, that's the situation there. The XLE is still kind of, that relative strength trade as I just showed. We talked a little bit also about the financials yesterday, the XLF. I want you to kind of look at this and, again, we got the breadth positive. We probably got about a 10-second delay for you. I've got the XLF up. We got the breadth still positive on our long-term, internal kind of meter, if you will, or the kind of the tide of the marketplace, as Basil said the other day when he was looking at this. 2370 unfair highs on the XLF, and you got 2387 sitting down here on the daily. So, that's. I know we're both. The rate environment is killing these financials right now, and they actually, are not looking very longish this morning. But after saying that, I want to take a look at the 10-year and get your analysis on this one, because this is obviously, along with the 30-year, affecting that XLF trade. So you want to do the most difficult analysis is look at the 10-year for me?
Yeah, go ahead, John. This XLF, I was going to say a couple of words about this XLF. If you would,
okay. Yeah, I'll pull it back up.
Pull it back up.
Okay.
I give you my 2 cents on it.
Okay.
I'm waiting probably, with a little delay.
Yeah. You got to get in you got to get in the Tiger Den today. We've been talking about that forever, but I'd love for you to get in there so you see the charts real time. That's one of the benefits of being in the Tiger Den. But go ahead.
Yeah, you have this upper balance area to 2370, and that upper balance area was in November, was formed on October, right, of this last year. And we do have multiple opportunities when price came back to retest that area just last week. Just yesterday, it came back to retest it at 2370. It's not an edge anymore, as you probably would incline to agree with you. That's kind of losing its edge of the on technical parameters, because multiple retests of the same area probably would lead into the penetration of that area. So 2370, anybody in the world can see right now from the simple chart formation from the couple days of the daily bars lows in there, and we're coming for the third time. I would not actually take this trade anymore as a long opportunity, but that's what I was going to say. Actually, it would stay out of it, even though it's long-term still long play here opportunity, but just for the reasons I stated, because it has been there for the too long, did not get follow through to the upside.
Right. Yeah,
I would stay away from
there's probably better longs, right? That's kind of the main concept is of what you're saying. I hear you loud and clear because of that rate environment. We'll come back and take a look at the 10-year in a second, folks, and a couple of stocks actually that are earnings related that are coming out today. We'll do some analysis on those. We'll be right back.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They've been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, guys. Welcome back to the show. We've got the 10-year Treasury up right now. We're going to take a look at. Eddie, are you still there?
Yes, John, I'm here.
Great. All right, so we crossed some borders. Obviously, 127.24 on the weekly closed above that strong move. I'm kind of in disbelief that we're revisiting these high areas that happened with that six-handle day. And let me see, was that a six-handle day? Oh, no, it was a six-handle day on the 30-year back in. Let's just go back in time here. Just to give everybody a heads up, on October 15th, the 30-year actually had moved up, or actually had a range of six handles. And the last time we saw that was back in 2008. And I think I remember the day that happened, if you know what I mean, Eddie.
Yeah, yeah, I remember. I remember that day, of course.
Yeah. Excuse me. So where do you think the 10-year's headed, and what would be the way to kind of regulate this trade up or down, in your opinion? I got the daily up now.
Yeah, I thought you were setting me up, but this is easy because it's just a clean breakout. It's strong breakout after it's actually not even strong breakout. Three sessions ago, we can see the slightly daily close above 128.15.
Right.
128.15, and that was a signal to go long with a stop 10% of the couple pips below 128.15.
Right.
And it's not like very strong because it was already one attempt to retest that area. So I would not actually go and pay high to jump on the trade right there. It's a little bit too late. But for the long players who got into the trade, and I listened to your show, you've been mentioning this breakout area, and you've always been playing alongside 10 years. So you called this trade good. But above profile highs, 128.15, that's what remains our re-entry area, as close as it can. Probably will not come close to this area, retest it. But we need, as you say, you like to say, you need to regulate this trade with the 60 minutes or to 40 minutes profiles. Yeah, 240, and try to pick up lows of the profile when the market just corrects itself.
Right.
If I can see that we have some retracement from the highs. We need to check 60 minutes. Maybe we'll if you look at the 240s, still no signal of anywhere, give us no inflection points where we can lean on the stops. But 60 maybe would be giving us a profile, and the lows of that profile would be low risk long re-entry on a short term. Here we go, 60 minutes. So the two profiles, one in the paired, and the second profile, we combine those two profiles in one. So yeah, previous profile lows. It's a gap between closing and 129. 06, right? 129.06. Right. That would be the long re-entry on this trade on a short-term basis.
Right. Obviously, Eddie and I are a big favor of levels, if you will. And Eddie's probably the technician of all times. I mean, you've got the Basels of the world, and a lot of other famous technicians. Eddie's right up there, and we've kind of gone full circle on quite a few ways to look at the marketplace. He uses a lot, or actually, why don't you kind of, Eddie, I'm kind of speaking for you here. Why don't you tell him a couple of things that you look at other than our profiles, and maybe how you've kind of come full circle on this, and maybe gone back to more simplicity than complexity, looking at some of the technicals.
In particular, what market you're interested in? Any market? We just look.
Well, no, I was just like in general. I know God, man, we started out with John Murphy's book a long time ago, and have studied everything in the world as far as technical goes. But I mean, this profile system that we've kind of developed that automatically outputs kind of makes things a little bit more black and white to me. I was just wanting to know your thoughts on. My
favorite tool, what we created, is a market landscape. When you hit on the simple scanner on the icon that allows us to see on one chart in one go 4 profiles on the same chart. That's my favorite, and that's very easy to figure out the market breadth and where the market is going. That's the best way, which I think what we created. Another thing, in many times I was looking for Fibonacci's, I was looking channels, I was looking for this, I was looking for that. But for instance, like we created E-mini SMPs, trading E-mini SMPs. I mean, I'm looking all kinds of stuff, in our boxes. But when we created this market breadth, it just eliminates one side of the market. Right. And just recently, this last dip, probably another one, the panic dip, we got long on 2000. Right. And that was 198 in 1998, long on the mini S&Ps. The reason behind that was a 60-minute box breakout. That was massively good dip, but for some reason, our weekly profile breadth was positive. So, without it, I probably was going to hesitate to look for this, look for that, and miss all this move. Take a look. We entered in 1998. We exited 1947s and 1950s. Didn't go short, of course, because long term was bread, but we took profits to the right places. So going back, what I love it and what we created, you and I, or our company, is market landscape. That means when I'll be able to see in a scanner on one go with one chart all 4 time frames in respect to the profiles. So
Right.
that's what it helps me to make decisions, and it definitely eliminates one side of the market, no doubt about it. I tell you, I tried a little bit some amateur, hour stuff because I believed it, because it's too high, because the oil is not going lower anymore. I tried to go long on ruble without any profiles appearing, no cigar, and just been stopped out.
Right.
And because it jumped too early in the game, no market is like ruble is going down, dollar is rallying, versus that there, and there were no new bucks. I say, okay, it's too far, too much. Fibonacci tells me, yeah, do it, and I tried it because I convinced myself. I find I find a reason.
Right.
And now I had to get out, and lucky did, and
Well, thanks for the input there. I've got the scanner. If we were talking about the landscape of the profiles, looking at them in one view, and as I look across, I'm just looking at the currencies on here. I'm looking at the euro. There's like as far as profiles go, there's like zero reasons to try to pick a battle on the long side with this right now, as well as going down to crude oil, as you can see that now right across the board. So what Eddie was saying, and what I'm a big fan of, is trying to eliminate one side of the marketplace. So if you're in that camp and you're using this information, it's okay to be short, not okay to be long right now, and there's not a lot of reasons to try to pick a battle on really any of the currencies that are highly weighted oppositely within the dollar right now, and or crude oil at this stage. You're gonna have to kind of sit tight, wait and see. I've got the DAX up right now, Eddie. Somebody had asked me to take a look at this. You're over in Europe, and we're actually having a breadth calculation come out on the DAX, I think in the next week, which is it's a couple more stocks that we're going to have to add to get that done, which will be another edge, hopefully, to trade the DAX. But I've got the daily up right now. Kind of any feelings on the DAX, especially relative to what the S&Ps are doing right now, and what the the Eurobond is doing right now.
I was not trading this thing, but before you've been pulling up the chart, some thoughts crossed my mind, and one of them would be the situation with as far as easing, quantitative easing of the Europe, that's starting the pace by copying what Americans done it. I think European money will be cheap, and that would help propel the DAX higher, right? The stocks higher. That would be the same model as far as fundamentals concerns, right? And we can see from the chart that DAX was underperforming. If you overlay E-mini S&Ps like European economy and United States economy, DAX was underperforming it. I think it will be the more strength right now, and the DAX will be catching up. European economy will be catching up with the American economy, because for the simple reason, because the money will be cheap. If the Central European Bank will start printing more money, and they said they will, right? So they're going to expand the balance sheet. That's what is going to happen, right? And technically, here it's a daily price back into the box, as we can see. It's already disconnect from E-mini S&Ps. E-mini is kind of went up and going down, retraced. DAX isn't. It's get back into the balance. So 9,728 is the bottom of the balance. I believe so that it makes a base. It's a little bit flat formation. It scares me all the time, like it's coming from 29 of the recent highs. Yeah, 29 of December, right? So DAX, in my opinion, technically, see, we already start breaking up above balance, above profile balance at 19,870, right? That's what the price is right now.
Yeah,
and
this
we have if we have close about 9870, multiple close, I would say multiple close, then this area becomes a breakout area. I would not like this white box, white profile of the breakout. Why? Because it actually constitutes a higher volatility.
Right.
I love breakouts of the narrower profiles. What that means the difference between the wide profiles and narrow profiles. Wide profiles, when they're supply demand area that is wide from each other, far distance from each other, then the buyers and sellers are actually have a big room inside a profile to agree with this place. When the profile is narrow, then it's easy to see whether buyers fell or sellers fell, which side market is going. So because the profile is wide, that means the more volatility in place, the more chances to be stopped out to playing those exactly top or bottom profiles as a support. Therefore, I would give 10% of the volatility and buy deep into the profile highs of the DAX and look for the long-term buying opportunities.
Right. Okay. All right. So to give some numbers on the short term for some of the guys who asked questions about this, the short-term numbers on the DAX right now, actually, I can go to the scanner and get them a little bit easier. So I'm going to go right to the scanner. The German DAX right here, the numbers we just looked at, 98.68 short-term unfair highs on the 240, 95.66, but then you've got the daily sitting there, 99.58 above there. So those are numbers to be aware of. I think probably, like Katie said, buying the breakout on the 240s is a little bit risky. I mean, the major inflection because of the width of the box, but the leverage is towards the upside. 98.68, based on what I just said, is the breakout with a, by the way, the stops on things like that are always relative to, excuse me, are always relative to the height of the box. So in our automated systems, what Eddie's speaking about when he says 10% stop, he's considering that, if you buy this breakout and you use this as kind of the fence, if you will, to orient stops around, the automated systems that we have are really taking, for the most part, there's some other factors in there, but for the most part, taking the height of that box point-wise and multiplying times 10%, that's kind of the buffer zone. And the cool thing is that that's not a monetary-based stop every time. It's kind of based on the volatility of the profile in general. So it kind of gives you a natural volatility component to the stop when you're looking at placing stops. And it's a great strategy to use because, when we do the back testing on that type of strategy, using that type of breakout or trade within the box or whatever with those stops oriented above or below based on the height of the box, the back testing actually proves itself proof of concept pretty well. Now, also based on what Eddie just said as a kind of a corollary to that, we've got things in automated systems, and again, this is trying to figure out a plan or a strategy moving forward based on some things that might have worked out in the past. If the boxes are relatively thin, it won't trade inside the box. It'll only trade breakouts like Eddie's talked about, like breaking out above or breaking out below. But if they're relatively wide, it puts more of a weighting system on trading inside those profiles that are relatively wide, because that's where more than likely the edge is. Now, we were looking at a 240 there, for example. Those strategies are mostly based on daily inflection points around these daily boxes for trigger points to get in and out of trades, or to get into trades most of the time. So we're talking about daily volatility. So when we talk about a daily wide box or high box here, this is where we're trying to buy inside the box at the bottom and sell inside the box at the top. And on those on the thinner boxes here, we're trying to trade breakouts, that concept. So right now, we're going to go to break. We're going to come right back, spend another 5 minutes with Eddie, and then sign off and try to cover a couple things before the market opens.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Catch Steve Rhodes as he teaches techniques on technical analysis using pattern recognition, celestial charting, Fibonacci, and other tools. The Trader's Edge, next on TFNN.
Hi guys, thanks for coming back. Here is the situation on the euro. I mean, this is, again, we call it the gift that keeps on giving. This is our 240-minute view, and this is the leverage point now to look at on the breakout on the downside, 117.83. This thing just cannot catch a bid for any length of time. Here's the daily, and now you're getting below 117.89, 117.90. You've got the daily unfurloughs, which have appeared today, and new box sitting there as we were predicting from yesterday. Now you've got a new profile area down here you can focus on. Thank God, for the first time think this last daily profile started before Christmas. Yeah. So now you've got something new to focus on here. And those daily unfurlows are kind of the breakout situation along with the 240-minute unfurlows. And, I know it's difficult to sell things in the hole like this, but this is kind of, when has this really treated you badly? And you've been given some great retracements back up into situations, inflection points there, especially on that weekly. If you remember back at I think that was 125. Just to review really quick here. Yeah, 125.74 right there. So again, this is something you're looking for reasons to sell breakouts or sell resistance, and that's kind of the opposite situation that we just talked about. The DAX it's almost the leverage is towards the north side, and I'm not a big fan of shorting that. So we're actually looking for pullbacks or looking for breakouts on the upside on the DAX. Got a couple of minutes left here. Again, here's the here's the British pound. And profile appeared here. Here's the inflection points yesterday, actually 150.94. Unfurlows looking a little bit stronger than the euro, actually. That's okay. The trend is still down on this. This is our daily on the British pound. We caught that sell at 156 the other day and some change based on the dailies and the weeklies lining up. And now we've got a new supply area. We'd love to see this thing retrace back up into 152.69. I think this is a wait and see. There's really no leverage here. You haven't had a daily close below profiles, so the British pound, you're just kind of sitting tight. And the inflection points to pay attention to, as plainly stated on the scanner here, are, there we go, 152.69, top of the box. And here's the landscape view, just to kind of give it all to you in one big mechanism here. 152.69. You're kind of right in not in no man's land, but there's not a lot of leverage on an intermediate basis here. Okay. All right. Got about a minute left here. We're going to cover actually one more thing before the market opens. We're going to remind everybody about the S&Ps, and talked a little bit this morning as we started the show. Look, getting stopped out a couple of times here, but still trying to use that 2027 area as defense. Our daily breadth may turn positive again. Some stocks may open, but again, we're trying to hang with the long-term view that there's more stocks trading above profiles and below profiles, and that imbalanced area towards the north side is still holding true on our long-term weekly view. And we've had some negative connotations without question on the shorter-term time frames, but again, this is a pretty powerful area to base some bets around, or some leverage around, I should say. I shouldn't say the word bet. 2027 again, stops oriented below, and we're just going to try to, put the odds in our favor here and may climb farther north. This crude oil thing has really rattled the market a little bit, but if you look at it from a 30,000-foot view, the market's kind of hanging in there, which is a good relative strength sign. Steve Rhodes is next, guys. Stay tuned. Pick it back up again tomorrow.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.